Welcome and thank you for joining us for today's PENTalk. If you have any questions during the presentation, please submit them through the question box. Tomorrow, you will receive an email with a link to replay today's broadcast. Let's get started. Hosting today is Tanya Weaver, Compliance Manager at Pentegra. Tanya, we're so excited to have you join us today, so now I will hand things over to you.
Great, thank you so much. I'd like to thank Elizabeth and Lauren for pulling this presentation together. They always make my job so much easier, so thank you for that. Like Lauren said, my name is Tanya Weaver. I'm the Compliance Manager here at Pentegra, and my primary function at Pentegra is to review plans for allocation and testing compliance. And today's discussion will focus on some areas of plan design for your consideration. We are going to go over 5 main topics within plan design. The mega backdoor Roth, long-term part-time, identifying when individual group language can strengthen your non-elective contribution, determining when a safe harbor CUNIC amendment is allowed and when to use it. And then lastly, we'll discuss class exclusions for part-time, seasonal, temporary employees and other excludable classes and how that impacts testing. So the first topic is the mega backdoor Roth. So probably about 5 or 6 years ago, I believe it was the Wall Street Journal, they came out with an article and they were talking about this huge tax loop where you could make an after-tax contribution to the plan and immediately convert that to Roth. Well, what they didn't further explain is that the after-tax contributions, this is a type of contribution that not only is subject to your 415 limits, but it's also tested under 401M. And what that 401M test is those are matching contributions within your plan. So if you have a client that's looking to do this type of a contribution, there's some pitfalls that need to be considered. So this is why sometimes the after-tax doesn't work, because you have to include that within your matching contribution testing. If you have a plan where the client isn't already offering the after-tax contribution, then it could be problematic when you go into testing. When you're testing the matching contributions, essentially what that test is doing is it's taking your highly compensated employees. Highly compensated are more than 5% owners, and those that make $150,000 or more in the previous year, and that's indexed for inflation every year. So an example, someone would be a highly compensated person if they made $155,000 in 2026, they would be a highly compensated for the following year. It's a look-back test. So if you have a bunch of highly compensated and you have some nons, and your highly compensated are the ones that want to take advantage of this, and they don't already provide a matching contribution, it most likely is not going to pass testing, and therefore this whole plan of trying to avoid a tax loop really isn't going to work. So before you dig and dive into that conversation with your client about the after-tax, take a step back and look at the plan and determine whether that type of a demographic is going to work for you. Where we see where it really does work and people can take advantage of it is in the solo plans, partners, or if there's demographics that the plan is only available to Highleys, or if it's just all available for nons. There's really no testing there. It's going to be deemed to pass. The other area where the after-tax contribution and conversion may work is if you have a retirement plan where they are providing a match and there's some room in your ACP test. So here I kind of provided an example to where if you ran the ACP test and if you're highly compensated had an average of 3% and your nuns have an average of 2.5, then that's going to provide an allowable limit, and actually that's in this print. It would be an allowable amount of 4.5. So the test passed with a disparity of 1.5%. So in that instance, you're highly compensated, they would be able to put in 1.5% of after-tax contribution, and there wouldn't be any failures. So that amount of contribution would be allowed and then converted. The other thing that you have to keep in mind if you're going to do the after-tax and then convert to the Roth is updating and amending the plan document. There's record keeper consideration and then operational considerations. For the plan document, it has to be amended to allow for the Roth and after-tax contributions. And then within the document, there's two different kinds of conversions. There's a plan Roth rollover conversion and there's a transfer. The key difference between these two types of conversions is the plan Roth rollover. That is when a participant has an eligible distribution, meaning they've maybe met the 59.5, or if the after-tax has allows for an in-service distribution after the money's been in the plan for 2 years. On matching contributions and profit sharing, you can allow in-service distributions once the plan's been in there for 2 years. So if the participant has a distributable event, then that would be an in-plan Roth rollover. A transfer is when the participant did not have a distributable event. And the reason why that becomes important is the transfer has to maintain any type of distribution restrictions. So with the after-tax, if there were no in-service, then the participant, even though it's in, a type of transfer or rollover account, they wouldn't be able to take a distribution. That restriction would have to maintain on that and apply. The other thing is to check with the record keeper. There's a lot of record keepers where they have limitations on what they can track as far as the conversions go. And then when the money is converted, some instances you're going to have a 1099 situation. For the after-tax, you wouldn't, but you need to confirm that your record keeper is not only going to be able to track that conversion, but if a 1099 is required, that they're going to be the one that issues that. Further, conversions have to be identified separately. They're still part of the plan assets. They're still considered for top-heavy. And the other thing that's different about a conversion versus a regular Roth contribution is each conversion carries its own 5-year clock. The reason why that's important is because a Roth distribution isn't tax-free until 2 events occur, until the participant is age 59.5, and then the other piece is that Roth contribution has to be in existence for 5 years. So if a client converts in March of 2025, their clock is going to start on January 1st of 2025. That needs to stay in there for 5 years until they take the money out and are age 59. If the next year they decide to do another conversion, well, that clock is going to start in 2026. The other topic we're going to discuss is long-term part-time. Long-term part-time, these rules came out with Secure. For 401ks, the consideration started in 2025, and for 403bs, that consideration started in 2025. The long-term part-time concept came because the IRS has this huge push to expand coverage for everyone in America. So they came up with this concept that if an employer has employees where they've worked at least 500 to 1,000 hours in 2 consecutive years, then they need to be provided the opportunity to defer into the plan. The look back period for that, it starts at 2021. So a client will need to look back to their census data from 2022, 2021 and prior is disregarded. So a client would need to look at their 2022 data, and they would need to be able to determine if they have any employees that worked that amount of hours for 2 consecutive years. And if they did, then they would need to be able to give them the opportunity to defer. That is the only piece that they have to provide for them. The other thing too is union and non-resident aliens. They can never be considered a long-term part-time. Those rules do not apply to that class of employee. The other thing to consider is if a client in their document has a class exclusion, and we'll go more into class exclusions a little later, but if a client has a class exclusion that's part-time, seasonal, and temporary, those exclusions are based on service, and the long-time, part-time rules, that would actually supersede those, and so those employees would still need to be brought in. So with the long-time, part-time rules, an employer could allow them to have different entry dates. An employer can decide what employer contributions they can. They do not have to have the same employer contributions as the participants that have met their regular eligibility. And then there's also a testing option to where employers can include those long-term part-time employees within their testing, or they can exclude them. They can't pick and choose and cherry pick which employees they want to bring into that testing. They have to bring either them all in, or they have to exclude them all. The other part that gets a little more complicated with a long-term part-time is if they meet the plan's eligibility, regular eligibility, then now they're going to become a former long-term part-time. And the reason why that's important is because they have a special vesting schedule. The vesting schedule for a long-term part-time is 500 hours. It's not the standard 1,000 hours. So once they move into that plan's regular eligibility, their vesting still has to be considered. The long-term part-time would still be included, their account balances, even though they can be disaggregated for non-discrimination testing. They still would have to be considered when determining whether a plan is top-heavy. And I've included some information on what makes a plan top-heavy. It's the key employee determination when they have more than 60% of the aggregate plan assets. If the plan offers an auto-enroll, the long-term part-time, once they become eligible, they are subject to those mandatory provisions. It's really not clear in the guidance if they can be excluded or included in that auto-enroll and mandatory provisions. If you have a plan that was grandfathered and wasn't required to have an auto-enroll plan, then that they would not be subject to it. So these are only the plans that are subject to the mandatory auto-enroll. And again, it's not super clear if you can exclude them for that. So on the conservative side, they should be included in the auto-enroll. The other part is for large plan determination, the long-term part-time, their account balances, they are included in that head count. And then long-term part-time, they typically have the same options as the normal eligibility employees, pre-tax, Roth, and catch-out. If permitted in the plan, you could exclude them from certain categories, but I think that would just make the plan design more complicated than it needs to be. So one of the things that can be done to avoid the long-term part-time rules is have an eligibility for the 401k plan that is earlier than the long-time part-time rules, such as 6 months, 500 hours, or 12 months with elapsed time. The thing that you can do with that is you can have your 401k, the salary deferral piece, have an earlier eligibility. That brings in your long-term part-time employees so that classification would no longer exist. And then then the client and the plan design can have the employer contributions use a later eligibility, or they could use the same. And the reason why that works is because when you're in testing, you can take your two groups and you can split them apart. So anyone that hadn't met the statutory eligibility of 21 and 1 year of service and semi-annual entry, they can be split out into a different group. So even though you're bringing those long-term part-time in earlier, you can have some flexibility in testing that would enable the plan to still pass as it had previously prior to bringing in all the long-term part-time employees. The next topic I would like to discuss is the profit sharing non-elective contribution. Another really great tool when you're going into plan design is individual group language. So a lot of people in the industry think individual group language equals cross-testing, and that's really not the case, or benefit testing. Individual group language is exactly how it's stated. Each participant is put in their own individual group when allocating a profit sharing contribution. When you have individual group language, this opens up a flexibility of how that profit sharing allocation can be contributed to the plan. You can still use pro rata, which is a comp to comp, aggregating all the comps and giving all participants the same percent. You can still use an integration with Social Security, where you have a base and the excess over Social Security is getting an additional contribution. And at the bottom of the slide, I provided that chart. You can also do an age-weighted allocation. So all of the safe harbor formulas that really don't require testing under 401A4, those are all available under individual group language. And they still would not have to be tested formally under 401A4. You could use stated rate groups that the client would use those in the background, and then the individual group language could be what's in the document. That would still be available, and then you'd have the individual group language. The one key thing that the plan wouldn't allow as far as a non-elective contribution when you move to individual group language is it wouldn't allow an integration of anything different than the 5.7 of the tax wage base. So when you're designing that allocation, if it turns out that Social Security wage base is going to be the most advantageous for the client, but they have to use a different formula than the 5.7 of the Social Security wage base, then you would have to move out of the individual group language and then into that integrated with Social Security and state that formula within the document. So here's just an explanation of, individual group language. Is it cross-testing? What cross-testing is commonly known as new comparability. It's just a technique where you're taking the profit sharing allocation, and instead of testing it on a rate basis, you're converting that rate contribution into a benefit. and then you're testing it based on that. This typically works really well when you have a demographic and you have owners that are looking to maximize contribution, and there's about 15 years between them and their staff. That is a really powerful tool to provide owners who are nearing retirement an opportunity to put a lot of money away in a defined contribution plan, and still at a minimum cost for the staff. So here's a couple examples where individual group can be really powerful. Again, like I just explained, you can do higher allocations to owners. I've commonly seen where employers will want to give employees a bonus at the end of the year, and they give them the opportunity to either take that bonus and put it into the retirement plan, or take it as, you know, a cash payment. It also allows the plan sponsor to have the ability to be very flexible in that allocation each year. So if you perhaps have a startup company and they are a little bit hesitant to commit to a certain type of allocation each year, this is a really great way for them to have that flexibility to be able to change what their contribution can be each year. Another common time that I've seen the individual group language used is if you have a company that has an old defined benefit money purchase or target benefit plan. In the background, they can still keep that allocation formula for grandfathered employees. And then for new employees, they can give them a different allocation. And with the individual group language, it allows you to design that plan to where the client doesn't have to write into their plan document this really detailed formula. They can just say it's individual group language, put everyone in their own group, and they can have these multiple level of different allocations. The other area where it would be very useful is in 403B plans. We commonly see that employers are making contributions on either a monthly or a per payroll basis, even though their plan document indicates as an annual allocation. So if they had individual group language at the end of the year, it would avoid a true up, and they could just keep everyone whatever they were paid throughout the year. And as long as testing passed, everything would be fine and dandy. The other thing too that I want to express is pretty much all of the examples here that would be subject to testing under 401A4. Examples when individual group language might not be a good choice, as we discussed, when it's integration that's different than the 5.7 of the tax wage base. And another time where it might not work is in a 403B plan if you have an allocation based on age and service, and there's one group that has a 0 allocation for the first 3 years. It's going to end up being a gateway pitfall. Gateway is required when you have individual group language because those rates are deemed no longer to be reasonable, and so the gateway rules would apply. So in that structure, it's not going to meet the objective of the client. Safe harbor plans. So Secure provided us the opportunity to retroactively to a safe harbor. You can amend to a safe harbor plan in a current year up to 12/1 of that plan year. And if it goes beyond that, you can amend to a safe harbor plan, but the QNIC would be 4%, and you could amend by 12 months following the end of the plan year. The retroactive safe harbor amendment is only for a QNIC. So if you have a client that wants to do a safe harbor match and they're adopting mid-year, what you could do is you could adopt to that 3% safe harbor, and then moving forward on a date in the future, you could change that to a safe harbor match. The thing that you have to keep in mind is this assumes that the plan already has a 401k feature, because you have to provide participants at least 3 months to have an opportunity to defer in a 401k plan. And then further, if it is a brand new plan, then that QNIC has to be allocated on the entire plan year. So situations when amending can be very beneficial. If you find out that a plan is top heavy, when a plan goes top heavy, there is a minimum 3% requirement on contributions. And if you amend to a safe harbor, then it satisfies the top heavy and it gives a pass on the actual deferral percentage test. That's another time, for example, too, when the plan fails and the plan fails ADP, ACP, and if the client doesn't want to distribute income back to the highly paid compensated, they can adopt to a safe harbor plan. This may also be very impactful when we get into the 2027 plan year, where you have highly paid individuals that failed the ADP, ACP test, and they're now required to have that recharacterization to Roth, and maybe the clients don't want to do that. So they can amend to that safe harbor plan. And then another time to do it is during the year when highly compensated want to increase the deferrals if they know that they've been traditionally failing the test. Amending to a safe harbor is going to give them that freedom to be able to max out the salary deferral limit. And as a reminder, safe harbor contributions, they're 100% vested. And if they're used in tandem with a cross-testing plan, that 3% can be used towards the gateway minimums when you're testing under 401A4, going back to the individual group language. The last topic here is class exclusions. I think really the key here and the main point is when you're designing a plan to be aware of particular types of class exclusions, especially the part-time, seasonal, and temporary employees. The reason why those are need specific closer attention is these particular class exclusions are based on service, and the IRS specifically does not allow exclusions for age or service. So if a part-time, seasonal, and temporary employee is being excluded, and if they work 1,000 hours, they can no longer be excluded. And then further, once they're no longer in that class, if they were to the following year drop back down to those part-time hours, they can't be excluded again. Once they're in, they're always in. And we find that a lot of plan sponsors are very confused on this rule. They don't understand, part-time, full-time is 1,000 hours. It's not a category that they provided them. The IRS doesn't recognize part-time and full-time. It's based on hours. If they're not tracking hours, then the plan document really should have an equivalency. And as discussed before, a long-time part-time participant cannot be excluded because of part-time, seasonal, and temporary. I did provide a list of class exclusions that aren't based on age and service. And if you're using class exclusions, the key to those is to make sure that you're not going to have a coverage issue. So when classes are excluded, if the excluded participants are being kept out of the plan, but they've met the plan's eligibility, then they have to be included in what's called a coverage test. And a coverage test is basically just answering, are the benefits of the plan being provided on a non-discriminatory basis? And the way that testing essentially works is you have the groups of the Highleys and you do a fraction of how many Highleys, how many benefit, and then you divide that by the non-Highleys, same thing. How many Highleys, how many are benefiting, and it comes up with a ratio. So if you have a client that is looking to exclude classes, be mindful of the amount of people that are in that class and kind of compare that to the amount of participants that will be eligible for that plan. When you do have failed coverage, there's pitfalls to that. If it's a 401k that has failed coverage, you're looking at a missed opportunity to defer correction, potentially additional employer amendment contributions. And then you have to do an amendment to the plan to bring in those employees because the client, has excluded those classes. So a plan designed to alleviate this need for an amendment is under the 410B coverage question that's within the plan document. You can choose this fail-safe. And basically what the fail-safe does is it builds in a step-by-step procedure for the client to correct failed coverage issues. Doesn't take away the need for the employer to make up any type of missed contributions, but it does avoid the additional cost for the client to do the amendment. And then I wanted to note that if they do elect the fail-safe, coverage has to be passed by the ratio test. The average benefits test to pass coverage it would no longer be applicable. So overall, key takeaways, just because you can't doesn't mean you should. Understanding and guiding plan sponsors and plan design really does solidify the relationship. As we know, a lot of the plan sponsors, sometimes they really don't understand the provisions, and it's our job to be able to communicate what they want to do, how to get them there, but how to get them to where not only is it going to meet their goals, but that it's also going to be administratively smooth and simple for them to operate their plan. And as we know, plan sponsors are seeking trusted providers. And if we can be in that driver's seat to guide our clients along, then we're just solidifying that relationship. And lastly, you're not alone. At Pentegra, we have amazing account managers. We have amazing relationship managers in a sales division. And we're here to partner with you to help answer these hard questions and provide a product that will be satisfactory to all the providers and the client. So I appreciate anyone's time today. We do have a chat if anyone would like to ask any additional questions.
Thank you, Tanya, for such a great presentation. And we'd also like to thank everyone for joining us. As a reminder, tomorrow you'll receive an email with a link to replay today's broadcast. Everyone have a great rest of the day. Thank you.